Are 50-year mortgages the solution to the housing crisis? Why Australia's big banks are struggling, and we examine ETF Overlap. Welcome to another episode of Equity Mates Investing, a show where we explore what is possible in the world of investing. My name is Ren, and today I am joined by Simon, aka Mr. Beat Up, aka a regular third host now. Welcome to the show.
Thanks, Ren. Great to be here.
Now, we should acknowledge right from the outset that Bryce isn't here. Bryce normally does that intro, so we have big shoes to fill. But I took a couple of weeks off and you've stepped in. And then Bryce has now got a couple of weeks off, and so you're stepping in again. So don't worry if you're missing the deep, dulcet tones of panic. Bryce. He'll be back in your ears before you know it.
Yeah, don't panic. Bryce will be back. But yeah, really excited to be here, Ren. As always, lots to cover, so let's get into it.
News and markets.
All right, well, two big stories we're covering today. 50-year mortgages are back in the news, and then we're looking at the earnings from Australia's big banks. Is there storm clouds brewing? But Simon, let's start with 50-year mortgages.
Yes.
Something that was floated by the American president. Yes. And you've done a bit of a deep dive to understand what it could mean.
Yes. So over the weekend, Trump did a post on Truth, like he does, kind of indicating that he was considering or looking at 50-year mortgages. The US Director of Federal Housing, Bill Pulte, he confirmed it on X. He said, "Thanks to President Trump, we are indeed working on the 50-year mortgage, a complete game changer."
Yes.
It's fair to say there's been quite a bit of criticism since this has gone out. Experts are warning it could actually explode people's total repayments, could fuel the housing bubble or make the housing bubble worse.
And for context, much like in Australia, the average mortgage is a 30-year mortgage.
Yes, that's right, yeah.
So you've actually crunched the numbers.
Yes.
Tell us what a 50-year mortgage looks like.
Yeah, so if we look at the numbers, I took a $500K loan amount, and the average interest rate at the moment in the US is about 6.2%. So I use 6%. So if we look at the 30 years mortgage, that's 360 months, $500K loan, 6% interest. Your monthly repayments would be just shy of $3,000, $998. If we then look at the 50-year mortgage, now you've got 600 months of payments, but your monthly payments do drop to $2,640. So saving of $358 is about a 12% drop.
Yeah, honestly, not as much as I thought you would save.
Yes. Yeah. It doesn't sound like that much, really.
Yeah.
And I guess when you actually look at it, it comes at a massive long-term cost.
Yeah, we'll get to that. But I guess just if we hold on the monthly payments, it's like the whole argument here, the reason that Trump floated it is because housing affordability is a problem in the US as well.
Yeah.
This doesn't really feel like it's making housing that much more affordable.
Yeah.
On the margins, but
yeah, it doesn't feel like a needle mover, particularly if you've got a lower loan size, which is probably where this would help people who generally can't afford their mortgage. It's going to be less than $300 a month.
Yeah, and now you said it's not a needle mover. Where it is a needle mover is in total payments.
Yes, so this is where you need to look closely. So People may or may not know, but when you have a 30-year mortgage at about a 6% interest rate, you actually end up paying nearly twice the amount you originally buy. So on a $500K loan, you end up paying $1,079,000. So you paid for the mortgage twice.
So that's $579,000 in interest for a $500,000 loan.
Yes.
And then how does that compare to a 50-year mortgage?
50-year mortgage, you look at it, you end up paying $1.584 million. So you actually end up paying triple the original loan and an additional $500K versus the 30-year mortgage.
Yeah, so the total interest bill is over $1 million.
Over $1 million. Your original loan was $500K.
Yeah.
So, wow.
And so people might be listening to this example and say, well, the argument for a 50-year mortgage isn't you pay it off over 50 years, but it's a way to start building equity. You know, you can get people into the housing market sooner, they can build some equity, and then they can sell and move and use the equity that they've banked. But here's the other problem with a 50-year mortgage. It takes longer to build equity. So with a 30-year mortgage, 14 years in, you've paid off 25% of the principal amount. But with a 50-year mortgage, it takes 30 years to pay off the first 25%.
30 years, you only paid off
Yeah,
a quarter.
yeah. And the reason why in both of those examples is when in a mortgage, the early years, you're basically just paying interest. It takes a while to start eating into the principal.
You're basically just renting from the bank, a 50-year mortgage.
You are
really,
renting from the bank.
really.
Yeah.
It's illusion of ownership because you're not really building that equity.
Yeah, that is exactly right. So the illusion of ownership, you're basically renting for the bank. We're covering off some of the arguments against it, but there are people who are defending it.
So this example here, if you used the $360 a month you'd save on that example we just went through, invested that in the S&P 500, took the average long-term, around 10% return, in 30 years, you will have accumulated $813K, which is obviously higher than that additional $500K. So you could just pay it off then after the 30 years and not worry about it.
Yeah, okay. But the challenge is that if this is an affordability policy, then you have to assume that people don't have that extra money.
Yeah. And it's like people aren't generally going to do that. And if you wanted to do that, you could just do an interest-only mortgage and then just use all the additional to invest. So I think that doesn't really make sense.
Yeah. Now let's close this out by talking about what I think is the biggest reason why this is a bad idea. This is just another way to perpetuate the ongoing, non-stop housing pump that we are seeing.
Another demand side policy.
Another demand side policy that allows people to spend more on housing.
So it might help buyers today to qualify for a more expensive home loan. So for example, someone who could afford a $500K home loan may be able to afford a $650K home loan now going to a 50-year mortgage. But that same increase in buying power will quickly push prices up across the board because everyone's borrowing power is going to increase. And then that basically then will just push house prices up potentially. And then it undoes all those monthly savings. So it just doesn't stack up.
It just once again helps existing homeowners.
Yeah. And then the other thing is just the lifetime of debt. So I saw a stat that the average age of the first home buyer in the US is now 40, the highest it's ever been. If you then go into a 50-year mortgage, you're going to be 90 by the time you paid it off. And we've talked about it on the show before, and a lot of these kind of lifestyle indicators of how good your retirement is going to be is generally based on owning your own property. If you're still paying off a mortgage during that time, what's that going to look like? And also just the psychological impact of being in debt that long.
Now, this is an American story, but this is creeping into Australia because Australia doesn't have 50-year mortgages, but there are a number of banks that offer 40-year mortgages.
Right.
So Credit Union SA, Pepper Money, and Great Southern Bank are just three examples that I found that are now all offering 40-year mortgages in Australia. So if you're thinking about it in Australia or if you're thinking about it in the US, I think you need to think long and hard about the total cost that you're signing up to.
Definitely.
All right, well, let's move to our second story. Australia's big banks have reported quarterly earnings and they're feeling the squeeze.
Yeah.
So just at a headline level, Commonwealth Bank continues to be the best performer of the big four. It reported profit up 2% year on year. But then the other three were all down. So Westpac profit was down 2%, NAB profit was down 3%, ANZ profit was down 10%.
10%? Do you know what was behind that?
Yeah, there was some one-off charges around redundancy costs and fines that they had to pay.
Fines,
I think
always fines.
Yeah, if you strip those out, they were sort of flat or down a percentage point or two.
Okay.
So Australia's banks are not doing too well. And there's a reason that I find fascinating, and it's that the big four are becoming the big five.
Yes, Macquarie.
It is coming like a bullet. So Macquarie's retail banking arm continues to take market share. In September, it grew its mortgage book and deposit book at 3 times the rate of Commonwealth Bank. Macquarie now has 6.5% of Australia's mortgage market and 5.5% of Australia's deposit market. And we can see that showing up in their earnings. So Macquarie reported quarterly earnings as well. Overall, it was a mixed bag for Macquarie, but if you drill down into their banking and financial services division, first half profit was up 22%.
Wow, that's amazing.
Yeah.
Do you use it, Macquarie?
Yeah, I use their savings account, the 4.5%. It's hoops, no anything.
It's so simple.
So simple.
Their online digital platform it's good.
Yeah.
They know what they're doing, and Yeah.
Yeah,
You can understand how they're taking share.
Yeah. They've got a real structural cost advantage as well over the big four. No branches.
True.
Yeah.
Yeah, I didn't think about that.
Yeah. So, and like very tech forward, where like a lot of these legacy banks are really playing catch up. So I had a look at mortgage market share in Australia. So Macquarie 6.5%. Then if we look at the big four banks, ANZ is fourth at 13%, NAB at 15%, Westpac at 21%, and CBA is the biggest at 25%.
25%.
Yeah. Now, so I guess you look at that and you see like Macquarie still has plenty of market share to eat. Yeah.
So what are you thinking from an investment perspective?
I own Macquarie.
Yeah.
Macquarie's earnings are going to be driven by more than just their retail banking arm.
Yes.
And so you have to think about Macquarie holistically. But what I am thinking is that I am not going to own the big four.
Apart from in your ETFs.
Yeah, I know. But that's a different thesis around index ETFs.
Yeah.
All three, aside from CBA, now trade below 20 price to earnings.
What's Macquarie, do you know?
I don't know Macquarie. I looked at CBA. It's at 28, so it's still, pretty expensive for a bank.
Most expensive bank in the world.
But I think this Macquarie story is a really interesting one. And I think if I was a shareholder in some of these other big four banks, I'd be really thinking about what their growth prospects are. Yeah. Now, I won't steal his limelight, but in the third segment today, we're going to play a couple of clips from a recent interview we did with Tim Carlton, because it was such a good interview on basis points that we wanted to share some of the insights. One of the clips we've got is him talking about how three of Australia's big four banks have lost their competitive advantage. So if you want more on why I'd be thinking twice about some of these big banks, stick around for that segment at the end of this episode.
Yeah, that was a great episode of Tim. Check that one out.
Let's ask the community. Hey, Equity Mate.
I just had a question.
Hey, Bryce, I've got a question.
Answered.
Diversification isn't just about the number of ETFs you hold. Today, we're unpacking the perils of ETF overlap. Now, this segment was inspired by a question from Isabella.
Hi guys, I hope you're having a great start to your week so far. Thank you so much for putting out the content that you guys do. I really love it. Look straight to the question. So I've got ETFs in IVV and VGS. And my question is, am I doubling up on those? Should I just keep the one? Any feedback on that would be great. Thanks so much.
All right. Thanks, Isabella. Love the question. So probably just to start with, what is ETF overlap?
So ETF overlap is when you own a number of ETFs, but the underlying holdings are the same in each. So the classic example would be if you own an ASX 200 ETF and then an Australian banks ETF, the major holdings in each of those are Australia's big four banks.
Yes. I think it's something most or nearly all investors will experience at some point on their journey. I know I'm still experiencing it today with the amount of choice there is out there and how generally portfolios develop over time. It's very common. So I think that's the first thing is don't think you're doing anything wrong. This is super common.
Yeah. Now, it's not necessarily always a problem, and we'll get to that, but why is it a problem?
So many think it's fees. So I think firstly, just to dispel that, because generally you only pay a fee on the funds you have under management. So if you have 5K in one ETF and 5K in the other ETF, you're not paying a double account administration fee for each ETF. You're just going to be paying the fee on that ETF.
Yeah. So to explain that, in my example before, we had the ASX 200 ETF and the bank ETF. Let's say they had the same management fee of 1%. If you put all $10,000 you're going to invest in one, then you're paying 1% on $10,000. Or if you split it $5,000 in each, then you're paying 1% on each of those 5,000. So the actual fee load isn't different. The problem comes from the illusion of diversification.
Yes, the risk here is that you're not actually diversified if you have ETF overlap, because the ETFs may have underlying holdings which are the same, so they're highly correlated. Yeah. If one moves one way, the other will move the same. So in the example here, IVV and VGS, they have a historical correlation of around 0.9 to 0.95, which basically means 90 to 95% of the time they will move in the same direction on any given day.
And just for people who are unfamiliar, IVV is the S&P 500 ETF, which tracks the 500 biggest US stocks, and VGS is the Vanguard MSCI International Shares ETF, which is a global index, but these days it's close to 80% US stocks.
Yeah. So you think you're getting diversification, but if you own both of them, you've still got 80% minimum in the US.
Yeah. So, we actually did have a look at these two ETFs in particular. The top holdings on each, just to give you the top three, NVIDIA is the top holding in each. In VGS, it's about 6% of the ETF. In IVV, it's 8% of the ETF. Apple was the next highest, 5% versus 7%. Microsoft was third, 5% versus 6.5%. So really, it's those big tech names that dominate both of the ETFs. And so the overlap is really high. And so to your point around correlation, when tech is going well, as it is right now, both ETFs do really well. But the risk is when tech falls off and something else is doing well, then both of your ETFs fall off and you don't benefit from whatever else is doing well.
Yes.
And that is really the fundamental point around diversification. Diversification isn't measured by the number of things you own. It's measured by your exposure to any one source of risk. If one thing goes wrong, it shouldn't blow up your whole portfolio. And global diversification, getting outside of Australia is a great example where if one thing goes wrong in Australia, it doesn't blow up your whole portfolio. It doesn't matter if you own 5 Aussie stocks or 500 Aussie stocks. You're not diversified because that one source of risk, something going wrong in Australia, blows up your whole portfolio.
Yes, and there's a famous saying in investing that diversification is the only free lunch in investing. Ren, you'll probably know who said that.
Harry Markowitz,
yeah,
the father of modern portfolio theory.
Yeah, so it's just an important way to actually lower the risk you have for the same or better returns, diversification. And you guys have done, and we've done plenty of other content on diversification. We can link into some other episodes in the show notes if you want to find out more.
So I said earlier that ETF overlap isn't necessarily a problem. I think the key thing is being aware of it and being aware of how much you overlap. If you want to enhance your returns with exposure to like a particular country or a particular sector, that's absolutely fine. We see a lot of people with like a global set and forget index fund and then maybe like a FANG Plus or a semiconductor or something. And that's fine. If you have a thesis around tech and you want that thematic ETF, and then you also just want like a global ETF, which right now is heavily exposed to tech, that's fine. You just have to be aware of the benefits and risks of being more exposed to tech. So I think to answer Isabella's question, like right now, yes, you are doubling up. You don't need both. That doesn't mean you need to sell one. If you've got capital gains on both, you might just want to hold them. But you should just be aware that you're less diversified than you might think. And for me, it would be as you're dollar cost averaging, as you're building your portfolio over time, maybe you start thinking about how do I diversify this portfolio with new contributions? So maybe it's an Europe ETF or an Asia ETF or an Australian ETF, whatever it is. Or if you don't have a lot of capital gains or you're not too worried about the tax consequences, you could sell one and use that money to diversify your portfolio.
So the other argument here as well is the simplicity.
Yeah.
And I know, Alec, I believe that's what you ended up doing. You took a slight hit on capital gains, but now your portfolio is 4 ETFs, very simple. You've got the diversification you need. It's automated.
Yep.
And now the admin headache of knowing all these different things you own is gone.
Yeah, it's horses for courses. It depends on what you want, how you want to manage your portfolio. But I think the two ETFs do overlap quite a lot. I think another one that you could think about, Isabella, if you just want to complement your US exposure with one simple ETF, there are a number of ex-US ETFs that are on the market at the moment. So Vanguard have one, VEU, and then BetaShares have one, EXUS, ex-US. So those two, if you feel like you're massively overly exposed to the US, one of those ex-US ETFs can be a nice complement there.
Yeah, and I think just to close this out, probably if you're listening, take a few minutes after the episode, look at ETFs, understand how many of your top 10 holdings actually repeat in your different ETFs. Are you getting the diversification you think you are? and that will probably put you in a good place.
Welcome back to Equity Mates. I'm joined by Simon, who's ably sitting in for Bryce while he's off. Simon,
great
how you
to
feeling?
be here.
Yeah,
Enjoying it.
yeah, that's good. So we spoke earlier about Australia's big four banks and how 3 of them are being challenged.
Yes.
And we thought that would be a good time to bring in some clips from an interview we did recently with Tim Carlton. He's the Chief Investment Officer of OzCap Asset Management. And this was on our Basis Points podcast, which we make for financial advisors. Every episode is accredited by the FAAA for CPD points, but it is freely available for everyone to watch or listen to. So if you're interested, you can go and check out all of our episodes. But we thought this was worth bringing to the table because Tim had some really interesting insights around private markets, which we'll get to, but around how 3 of Australia's big 4 banks are losing their competitive advantage.
We got a lot of good feedback on this episode. Tim is a very popular guest. He's got some really well thought out opinions. I personally love this one. So yeah, hope you enjoy it.
So here's the first clip with Tim talking about Australia's big banks.
The one area of the market that's been really hot that makes no sense to us is in the financial space. We actually think, this may be a big call, but I actually think that at least 3 of the 4 banks have completely lost their competitive advantage. And if I just explain that for a second. So a bank is a pretty simple proposition. They need people to give them deposits so that they can then lend that money to borrowers, right? And so your 2 groups of customers are the people that give you deposits and then the people that borrow from you, right? And the banks have done a pretty good job at irritating both groups of customers for a long time. And so it hasn't taken much for a serious competitor to come along in Macquarie and disrupt that equation. And because of what the banks have done, they're allowing that disruption to happen really easily, and we think it may well accelerate. On the deposit side, the way banks have treated their customers for years is, to me, absurd. So when you get 50 basis points in your savings account, right, when the cash rate's near 4, they are effectively charging you 3.5% as a management fee annually for them to hold your money, right? I mean, the funds management industry gets criticised for fees all the time, and yet you look at that situation and you think it's absolutely ridiculous. And so all it took was Macquarie to come along and say, well, actually, why don't we give you something that's pretty close to the cash rate? And all of a sudden, they are attracting an enormous flow of deposits because you can get 3.9% at call up to a couple $1 million, and then it doesn't drop that much, actually, even if you are in the uber wealthy camp that has more cash sitting on the sidelines than that. And so then you think about the other side of the equation. What about the borrower side? Well, the great thing about NAB, ANZ and Westpac is they've completely cut their tie with the end customer in the majority of cases. So more than 70% of loans that they write today in the mortgage market go through a mortgage broker. So they don't have a relationship with the end customer anymore. They have a relationship with the mortgage broker. That is an absolute disaster for the banks that hasn't really come to fruition until I think now, right? Because all it means is that the mortgage broker is the customer. They only care about 2 things. They care about the lowest rate that you can offer to their client, and they care about turnaround times.
Yeah.
So if you can compete on those 2 things, you can take share away from the majors very, very easily. And we're not talking about them relying on this channel for 5% or 10%. It's north of 70% of the mortgages they write, right? For those 3 banks, CBA is actually the inverse, more than 70% come from their direct advisors. So they have effectively outsourced that relationship, which means that Macquarie can come along and steal that relationship very, very easily, right? And they're able to do that because they have a natural cost advantage, right? So if you think about Macquarie, what's their cost advantage? They've got the best tech stack, right? Somewhat unbelievably, Westpac's just about to start an integration of, I think, 18 or 19 systems that go back to St George days, which is somewhat remarkable, right? Well, Macquarie don't have that. They don't have a legacy tech stack. And then really importantly, they don't have branches. Try depositing cash with Macquarie. You can't. Yeah. It's very, very difficult, right? It's electronic only. But these days, that's what a lot of people care about. They want to transfer funds electronically, right? And so that's meant that they've actually got a superior proposition in terms of the return on equity that they can deliver, right? Making the same loan at the same price as their peers, right? And just to put this in context, they've gone from 3% to 4% to 5% to 6.2% over recent years of the mortgage market. In July this year, July 2025, they were responsible for 39% of the growth in loans in the mortgage market.
Wow.
Wow.
Right? So we had thought even prior to that data coming out that on the basis of the track record over the last couple of years, they would probably go past ANZ and NAB in market share in the next decade. Well, if they continue with this sort of acceleration, it's going to happen a lot more quickly than that. So we actually think, 3 of the 4 banks have completely lost their competitive advantage. The only advantage they have left is incumbency or people's unwillingness to move. But when you see the value proposition both on the deposit side and the lender side, we think that inertia will start to change, or they'll have to respond, in which case that lowers their own margins over time. So for a part of the market that makes up a quarter of the ASX 200, it's reasonably extraordinary. We think that this isn't getting more airtime.
But you're sort of bullish Macquarie.
Well, Macquarie are the other side of that equation, which we are comfortable with the returns that they think that they are generating in the mortgage market. We hear that they are very strong given their lower cost structure, which is why they are competing aggressively. And we can't see any reason at the moment why that shouldn't continue, if not accelerate.
So that was the first clip from Tim. I think a really interesting insight in how 3 of the big 4 banks are losing their competitive advantage. And it really mirrors what we saw in their quarterly earnings. So here's the question for you, Simo. As an Australian with a mortgage, did you go direct to a bank or did you go through a broker?
I went direct to a bank.
Oh, did you? Oh, well, that absolutely defeats my whole point.
But this was a few years ago. Been speaking with a broker recently looking to remortgage.
Why did you go direct to a bank?
Just the rates were so good.
Okay.
Like just doing basic searching online, and what I was looking for was pretty straightforward. So it worked for me, but it wasn't a traditional bank. It was a non-finance bank lender.
Yeah.
Backed by Bendigo Bank.
Okay.
And the rates were just super sharp.
Yeah, right. Okay. Yeah. Okay. Well, that still does kind of prove the point that these banks are all now just competing on price.
Yes.
And the big 4 banks have a structural disadvantage because their cost structures are a lot higher.
100%.
So that was the first clip from Tim. This second one is all about private markets. We've seen just an absolute explosion in private markets in Australia and globally over the past few years. He was making the case that private markets may be a little bit of an illusion and that the risk-adjusted returns may not be as good as people think. So here's this second clip from Tim.
Okay, well, if we start from the beginning, the starting point for any comparison of assets is the return that gets delivered from that asset, right? Now, it didn't take long for someone to come along and say, well, that's not fair. You shouldn't compare an equity return to a government bond return. If they both deliver 6%, surely the 6% delivered by a government bond was much lower risk than the 6% delivered by the equity market. And that was self-explanatory, and so people started to think about risk-adjusted returns. But of course, we can't measure risk, and so we needed a proxy for risk. And the proxy that has been settled upon is volatility, right? Volatility of returns or volatility of price, right? But of course, volatility is not risk. And to make that really simple case, you can have identical real estate assets, right? One that's listed on the market and one that sits in a superannuation portfolio and gets marked at director vals or external vals every 6 or 12 months. And clearly the exact same set of assets will have different volatility measures. One's in the public domain where it's traded actively from 10 o'clock to 4:10 every business day of the year by a whole group of investors with varying degrees of knowledge and sophistication, and the other is marked by professionals once every 3 to 6 months or occasionally every year, right? So if two groups of identical assets can have very different volatility characteristics, then clearly volatility is not risk. But of course, once that assumption was made, off that was spawned a whole bunch of different ratios and metrics that people analyse because they think it gives them a fuller picture of a particular investment. So we've got Sharpe ratios and Sortino ratios and information ratios and tracking errors and everything else all spawned off the price volatility of a particular asset. Well, of course, there's lots of super smart people in finance. And so the smart people in finance realised, well, to get better risk-adjusted returns, we can actually change that equation so that it's in our favour, right? And the first thing you want to do is you want to take it off being marked 1,000 times a day from 10 o'clock to 4:10, right? And so you remove the number of data points, because definitionally, if you remove the number of data points, you're going to have less volatility, right? And then the second thing they do is they say, well, let's take away all of the less sophisticated players. Let's not let mums and dads mark that asset. Let's not let fund managers mark that. We're just going to mark it based on an independent external valuation that's done every so often, right? And so all of a sudden, these assets that are in the private sphere with similar or even worse return characteristics to their public equivalents, on a risk-adjusted basis, so take the return and divide it by the standard deviation, they suddenly appear a whole lot better, right? And we saw great examples of this through the COVID period. You know, take the largest, we talked about it already, the largest automotive group in the country is Eagers. They have about a 14% market share. They dwarf the number 2 player, which is down in the low single digits, right? And a number of private equity houses own dealership groups that are, you know, sub 2% in market share. Well, Eagers' stock price during COVID fell 70% peak to trough. And obviously then on the rebound, you get the volatility in both directions, because volatility is just price change. And that contrasted with some of the markings that we saw in private equity portfolios for much smaller, much less sophisticated, much less capitalized businesses that were sort of orders of magnitude smaller. I'm talking 5 to 10% from peak to trough at the director vals, right? Now, clearly Eagers is not an inferior business. It's not a riskier business than those other businesses. But that's the problem when you take a concept in finance and then manipulate it in a way that produces superior outcomes for the purpose that you're trying to achieve, which is let's move more capital out of the public market and into the private market, ignoring obviously all of the detrimental side effects of doing that. And the most obvious of those being, you know, a lack of liquidity, which we're starting to see in private markets now.
All right. Well, I hope you enjoyed those clips from Tim Carlton. If you want to watch that whole episode, the link will be in the YouTube description or the podcast show notes. But Simon, that does it for us today. Thanks for stepping in.
Yeah, thanks. Looking forward to the next one.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful. Equity.